Up, Founders Embassy. Sorry. How are you guys doing this morning? Great. One great. There's one person who's great and like 90 people who are okay. All right. Let's see if I can get this there. All right, here's my presentation. I'm going to talk to you about international entrepreneurs and how they can set themselves up to raise money from US investors. That's a very common question that we would get at YC. Because as the classes grew, more and more of our YC batches became international founders. I think it's up to maybe 35 or 40% now. And so, that was a common question. How do they set themselves up? Before we begin, I want to tell you a little bit about who I am and maybe why you should listen to me. I started a lot of companies, starting about 13 years ago here in Silicon Valley. The one that actually worked well was called Twitch. There were a lot of ones that didn't work so well. I put the logos up there for your, at the top. And then I invested in a lot of companies, some of which worked really well, and some of which didn't work so well. And as I was assembling this slide, I realized a lot of those companies were actually international companies. A lot of them, like Scotty, Automild, Paystack, Razorpay, Zendit, Sendbird, Bellabeat, all started off as companies in another country and either moved here or ended up incorporating here in order to raise capital. They often would come here to get access to the Silicon Valley culture, which I'm sure a lot of you guys have come here for today. And they also came here to get access to Silicon Valley capital. And so, over the years, I've seen a lot of things. I've seen like what works. I've seen a lot of things that don't work. I've done a lot of things that don't work. I've done a few things that work, and I would like to share them with you. All right. So the first step, I think, is to ask yourself why you even want to raise money from US investors or come here at all. And the number one answer is often access to capital for international investors, international founders. One of the top complaints is there are no investors in, my home country of X or my home market of X. And I think that's changing a little bit now, especially, in certain markets like China, maybe a little bit in Southeast Asia. But largely, it's true that there are just more investors, both on the angel side and the venture side in Silicon Valley than anywhere else in the entire world. So oftentimes we see founders come here because they want access to those investors. The second reason is they want access to the knowledge of how to help you build how to help them build their company. So, Silicon Valley is home to many giant internet companies. Obviously, the Facebooks and Googles of the world, and it also has created this massive secondary ecosystem of people who have scaled before. They've scaled the technical side, they've scaled the operations side, and oftentimes that knowledge isn't as readily available in the rest of the world. And so coming here and talking to experts who have done it before, learning from them, maybe getting them on your side, invest in your company, is a great way to accelerate your process. And lastly, I think there's more willingness on the part of both investors and participants in the ecosystem, so people who have done it before, employees, founders, to work with and back and participate in international companies. I think I joined the board of one of my international investments for the first time ever last year. And it's just because there's more and more opportunity as the rest of the world, as mobile has kind of grown in the rest of the world, and there's more people buying goods and services online. The opportunity has shifted from more people thinking the US is kind of the entire world in terms of market to the outside world being very interesting from an investment perspective. And greedy US investors like myself want to participate in that as well. So it's a timing thing. Now's a good time, as good of a time as ever, to get the participation of US investors and entrepreneurs in your international startup. All right. So if you want to take this path, what is the way to do it? The first thing is something that YC didn't require at first, but then started requiring a couple years ago, was that every international company flip to a US company. And so what's a flip? What does that mean? It's when you create a Delaware C corporation and exchange shares with your foreign entity. So effectively, you have a US entity that's investable by investors in the US and globally. And the reason that's important is actually a lot of funds and a lot of investors don't want to invest in an international company. And the reason for that is there's these like additional horrible tax reporting requirements. Oftentimes it's written into their LP, limited partner agreement. And so it's really important. It sounds like a small thing, and it's kind of bad for you in certain ways. It's a bad tax burden, but it's something that's pretty necessary if you want to get investment from U.S. investors, and it's something we definitely recommend. Some of the companies that I invested in fact, all of the companies I invested in have done that. A lot of things to consider. I'm not going to go into them today. We started this company, Atrium, a year ago, actually, almost exactly a year ago, to help innovate in the legal space and make legal much more easy for founders and entrepreneurs. And we work with a lot of international founders as well. So we have a bunch of experts who can help you with that. But the things to consider are the tax implications, IP, like which entity owns the IP, and how you structure commercial agreements between these two entities. But I'm not a lawyer, so I'm not going to tell you about those things. And plus, it's a little too boring for a stage presentation. All right. The last thing I'll say is you should do it now. If you want to do it, the complexity of flipping your organization only grows over time as your organization grows, your number of employees grow, figuring out how to get them equity in the U.S. entity so that upon an exit, they'll be able to participate in that. Becomes more and more complicated as your headcount grows and your business grows. So my recommendation is to do it as soon as possible. And you will save yourself legal fees, but you will also save yourself a tremendous amount of pain, which I think is my non-international related recommendation as a founder is, strive to reduce your own pain. All right. So after you've done that, what do you need to do? First thing is build this icon, rocket ship. You need to figure out, everyone always wants to figure out what the hack is to raise money. But the real hack is to build something that has product market fit and is actually working and growing really well. So I think I would spend 95% of your effort on, instead of like trying to figure out what the fundraising hack is, to spend the 95% of your effort on talking to your customers, figuring out what they want, how to make what they want, delivering it to them, and getting feedback. And if you do that, hopefully you will iterate into something that eventually grows really well. There we go, achieve product market fit. That's what we did to create Twitch. We did not come up with a great idea around allowing people to stream video games to this apparently massive market of over 100 million people every month. To discover Twitch, we started off with this really horrible idea, which was that I was going to create a live video show about myself, kind of like Big Brother, and we started broadcasting it to the internet, and people came to it expecting entertainment, and they found four internet programmers sitting on their computers programming. They were like, this is a horrible show. And eventually they asked us, they were like, we want to create our own live stream. So we created this live streaming site for anything. So we kept talking to our customers over the next couple of years, and we discovered one of the things that they wanted was to stream their own video gameplay. Started working on that and just talking to our customers, figuring out what they wanted. They wanted to get paid. We created the partner program for them to make money. And after years and years of iterating, like 8 years of iterating, we finally grew it to this pretty big website. It's actually now number 12 in the United States, which is pretty awesome. And in 2014, we ended up selling to Amazon for $970 million. So there really is a way to iterate and talk to your customers to achieve success. And I really think that's what you should spend most of your time doing. Second thing that's really important, especially for international founders, is you want to be attacking a huge market. If you're not attacking a huge market, it is extra, or if investors don't perceive you to be attacking a huge market, it's extra hard to raise capital. It's also extra hard to kind of actually build a big business. That was a problem that we ran into at Twitch, right? People thought this watching people play video games market was extremely small. And they felt like it was small because of their own impressions. In fact, despite the actual eventual size of the market, right? So it turns out it was a big market, but it was really difficult for us to raise capital because it wasn't perceived as one. For international founders, I think it's really important that you be attacking a large market and really be thinking about how you present that market as large because well, oftentimes, because of it, I guess U.S. centrism, people here think like the U.S. is everything and, whatever country that you're attacking isn't like a big enough market. So you want to take pains to make sure that you are attacking a big one. And oftentimes that means aggregating an entire region or attacking verticals that people know are going to be big, like transportation or food delivery. All right, what's next? So I always talk about fundraising as starting with narrative. So once you have, let's say you've done the 95% of the work and you have figured out a great way to achieve product market fit, your company's growing, and you want to raise capital, right? What's the next step? The next step is figuring out a narrative, and a narrative has three parts. Every narrative in human history has three parts. It is, the world is a certain way, and then something happens, and then the world's now a different way. So how does that apply? I mean, that sounds super simple, but how does that apply to fundraising or to your company? I think you always want to think about structuring your narrative and your conversations with investors as going through these three acts. In the first act, you're telling them about the product, the market, like where the market's at, what the problem is, why it's a big problem, and then there's some inflection that happens, something changes. Maybe it's now everybody has a mobile phone, maybe it's now everyone has a credit card, maybe it's now there's lots, everyone wants to buy something online, buy things online. And so then you go into what's changed, right? So something has changed about the market. Maybe it's your insight, maybe it's you're in the right place at the right time even. And then lastly, the third act is the world's now a new way. What does that mean? It's like that's the example of what your product is, how it solves a problem, what your traction is, the evidence that you're going to reshape the world. And I think it's really important to have a very practiced and rehearsed narrative that kind of walks people through a story arc where at the end of it, they end up believing that you are going to be something really big. And so I encourage people to just practice, iterate, try different things until you find that narrative that really resonates with people. And you don't have to practice just on investors. You can practice on your fellow entrepreneurs, other people in the industry, and you'll start understanding that your narrative is working when they are getting excited about it. Okay, so step 4, another thing that people always ask is how do we determine our valuation? Well, valuation in early stage companies is completely made up. It's completely not disconnected from your revenues. It's really much more tied to your potential. So stop trying to worry about calculating based on the thousands of dollars of revenue a month you're making and start figuring out how to pitch that giant narrative because that's what's really going to drive valuation for you. And then think about raising enough money that you can last 18 to 24 months to achieve some set of milestones that are compelling and give yourself a buffer. There's lots online about this, so I definitely recommend reading up. But the really important part is a lot of times people get trapped in this thought of my valuation has to be dependent on some financial metrics, and in early stage technology companies that is very much not the case, luckily for all of us. All right, so now that you have a plan, you have a narrative, you want to figure out what investors you want to go pitch. And the first part is I think that you should save your time and save your potential investors' time by really isolating and zeroing in on the investors who are most likely to be interested in your business. So there's a lot of investors who, if that means if you're a biotech company, you want to raise money from people who have invested in biotech companies. If you're an international company, you probably want to figure out people who are actually even open to investing in international companies. So I would do a lot of research. You could do research, look at what people have invested in on Crunchbase, or on AngelList, and figure out who are make a list. Just make a Google sheet or an Excel on who you want to potentially get intros to. And then you want to target the right people to give you that introduction. So it's really hard, and my last bullet point here is it's super hard to cold email people. I get actually probably half a dozen cold emails from people who want money every day. That's too many people to give my money to, unfortunately. And so it's really important to get a good intro. Luckily, it's actually not that hard. There's lots of people here who can probably help you, your batchmates at Founders Embassy, other entrepreneurs, people who have raised money from those investors before. Just do this systematically, make your spreadsheet, figure out who maybe one of your existing investors can introduce you to some investors and kind of like, just line them all up and then ask those people for an intro. In that intro, you want to create a short, concise summary of why you're a compelling investment. It probably runs through, in like 7 to 8 sentences, those 3 narrative arcs very quickly. And that's really important. All right, then once you get these intros, what do? Go and prepare to these meetings. The first thing is I would avoid all assumptions. You should not assume that people know about your industry. You want to be able to explain your business and your industry like you are explaining to somebody who doesn't know anything and is reasonably smart person who has no context. And so that means making it really concise, making it simple, walking them, not using like industry acronyms or anything like that. It's really important because like basically any chance that someone has to check out of a conversation, they're going to do it. They're going to go look at their phone or be distracted, think about their actual problems in their life, and you need to keep them engaged. And so do that by running them through this powerful narrative and keeping it super simple. You want to know what you're doing in this first meeting, based on the type of investor you're talking to. For angel investors, they may be ready to write a check immediately afterwards. For venture investors, they're probably going to ask you to follow this process, where if they're interested, they're going to move you along to a meeting with multiple partners, and then from there, a meeting with maybe other partners, and then from there, maybe a full partner meeting. So do your research first, figure out who you're talking to. I like to put this one in there. You want to be really honest and upfront. I think being authentic is a really powerful motivator for people, for connecting with people. And you want to be honest about the things that are really compelling and good about your business. Hopefully you believe in it. And you also want to be upfront about the things you don't know. It's really bad to just make up an answer. If they ask you a question that you don't know the answer to, it's really bad to just make up an answer. Usually people can tell that you're bullshitting them, and so it's important to be very authentic and honest, and I don't know is an okay answer. It's better, though, if you really know your numbers and know all the metrics of your business, so you should take pains to make sure you do them, and the bonus is that you'll actually probably run your business better if you do. And lastly, you should think about what your unique selling point is. Hopefully that's woven through the thread of your narrative, really understanding what's the most compelling few facts about your business, and making sure that you hit on all of those is incredibly important. Okay, so once you've had this great conversation, they were asking you questions, they were super engaged. What happens next? I think you want to make sure you're direct in your ask, and make sure to say, hey, we're raising our seed round. Are you interested? Or what's the next step? Trying to figure out how to move the conversation along to them actually investing. Oftentimes then they'll be like, oh, well, what are your terms or whatever, and then just, you want to kind of push the conversation along without being too pushy. I think it's really good to have a time frame for in your fundraising. It's not to say that you should just say, oh, I'm closing at this date, because usually if you don't have any leverage, that's, people will detect that's bullshit. But it's good to say, I'm spending the next 2 weeks talking to investors, and then our goal is to close our seed round, right? The last thing is, this is something we had at YC, the handshake protocol. If you agree on something, on terms, and then you email each other in that agreement and shake on it, then you should stick to it instead of finding out, oh, I could get a better deal from another investor like the next day, and then kind of going back on your agreement. Silicon Valley is based on trust. It's based on the trust of investors doing what they say when they agree to fund companies, and vice versa. And I think that's really important for your reputation. Final notes. All right. Fundraising is a tool to build your business. It's not the end game. Raising a lot of money sounds super fun and attractive. Maybe the process doesn't sound fun, but having it might sound fun. But really, it's just a tool to build your business. And you should raise that capital when you are constrained by cash in building your business. And if you're not constrained in terms of resources, you should probably just continue building your business independently and not worry about fundraising. And oftentimes, we'd see this at YC. I've been caught up in it myself, in getting in, and caught up in this fundraising beauty contest where you're trying to get the highest valuation or the most money. Inevitably, that is never the thing that makes the difference at the end of the day with your company. Startups are, Paul Graham used to tell me that startups are a pass-fail course. And so, really, if you're just trying to get enough, you're trying to build your business, and if you IPO or M&A, that's a success, and it really doesn't matter that much. Optimizing for valuation along the way doesn't really matter that much. It should be focused more on getting to the pass. And lastly, I think it's especially relevant for you if you are raising money in a Series A and you're going to have someone join your board. But you want to find somebody who is going to be a long-term good partner for you. If they're joining your board, you're going to have to see them. They're like the only employee you can't fire. And so you'd better get somebody that you actually want to hear from, that you actually like, you want their opinion on. You don't want to get someone who annoys you. That's not fun. So really focus on getting that long-term partner. In a seed round, maybe that's a little less important. But because they're not, they don't have any direct control, or maybe raising money from 10 or 20 people. But really finding investors who are helpful to you is something that I would focus on, because maybe only 25% of investors end up being helpful. The other 75% might say they're helpful, but actually might not be helpful or might actively be harmful, and you want to avoid those people. You can do reference checks, which is a great way to find out more. All right. Lastly, how I can help further. Started this company called Atrium. We help founders with legal. So if you do have questions, you can send us a note. It's atrium.co. We also run this boot camp called Atrium Scale, which is a free boot camp for founders who want to raise money. And we do that because it's really good lead gen for our law firm startup. But it's also something I like doing. And so it's like a 2-day boot camp that we do every couple months in Silicon Valley. And you can apply online. And lastly, we created this blog where we kind of give our best fundraising tips and knowledge at atrium.co/blog to learn more about any of these topics that I just touched on. And that is it. All right, thank you very much.